Today, Credit Suisse has a problem. Hello again, it's Martin North from Digital Finance Analytics, one latest post covering finance and problem news with a distinctively Australian flavour. Well, Credit Suisse Group faces a potential capital shortfall of as much as 8 billion Swiss francs or $8 billion in 2024, according to analysis at Goldman Sachs, underscoring the challenges for the troubled lender as it nears what's likely to be a deep restructuring. At very least, the Zurich-based firm is facing a hole of 4 billion francs, given the need to restructure the investment banking operations at a time of minimal capital generation, the analyst said. That meant it would be prudent for the lender to raise capital. Credit Suisse continues to face cyclical and structural challenges, the analyst wrote in a note, maintaining a sell recommendation on the stock. The firm is exploring radical cuts to its volatile investment bank, including spinning off large parts and hiving off its securitized product group, as Chief Executive Officer Ulrich Kroner seeks to put an end to years of scandals and losses. Yet, with a key question, how to pay for it, unanswered roughly 2 weeks before he's due to present his plan, speculation about the lender's financial strength has sent its shares on a roller coaster ride. The stock rose as much as 2% on Tuesday and was trading up 0.5%. While raising capital is one option under consideration, Credit Suisse executives would strongly prefer not to issue equity with the share price near record lows. Credit Suisse has a CET1 capital ratio of 13.5% as at June 30th, well above the international regulatory minimum of 8%, and the Swiss requirement of about 10%. Its liquidity coverage ratio is one of the highest among European and US banking peers. But Credit Suisse shares have plummeted 50% so far this year. And Goldman's comments were echoed by Jefferies analyst Flora Burkhardt, who said in a note on Tuesday that Credit Suisse needs to build about 9 billion Swiss francs of capital in the next 2 to 3 years, but given the dilutive nature of a capital increase, they expect it to prioritise asset disposals. Bloomberg News reported on Friday that bidders were lining up for the bank's securitized products unit, a key pillar in the downsizing of its investment banking operations. The sale process, which is far advanced, has drawn interest from PIMCO, Sixth Street, and an investor group including Centerbridge Partners. And the bank is also considering bringing in an outside investor to take a partial stake and inject money into a spin-off of its advisory and investment bank businesses. Credit Suisse has also said it is working on possible asset and business sales as part of the plan scheduled for October 27th, alongside earnings. Other potential disposals include the sale of its Latin American wealth management operations, excluding Brazil, and the Latin American region accounts for about $100 billion of client assets and loans. That includes its businesses in Brazil, where it also has significant investment banking activities. Closer to home, the bank is also considering selling its 200-year-old renowned Savoy Hotel, located in the heart of Zurich's financial district. The building could be worth about 400 million Swiss francs, or $401 million. So, whichever way you look at it, this is a very unfortunate time to be in the middle of a discussion about major restructuring because, of course, liquidity is under question at the moment and the financial system is highly volatile, putting extra pressure on Credit Suisse. And it'll be interesting to see how it plays out over the next little while. This is certainly one to watch. And, of course, Credit Suisse is within that select few banks that are globally significantly important banks, meaning if something goes badly wrong, it could have systemic risks across the financial system. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.